Hi everyone and welcome to the First Mortgage Trust Market Update. I'm Paul Bendall, CEO of First Mortgage Trust. Now I know that our investor meetings are very important to you and it's been some time since we've been able to hold them, but I'm pleased to say that next year we'll be holding investor meetings in person. But in the meantime we thought we'd do the next best thing and provide an online update. There's obviously an awful lot happening in the New Zealand market at the moment, be it inflation, rising interest rates, supply chain disruption, and obviously a lot of commentary as to what's happening in the property market. So we thought we'd bring in Tony Alexander, renowned economist and property market commentator. Before I put a few questions to Tony though, I thought I'd just give you an update as to what's happening in FMT. So firstly, I want to thank you, whether it be on the investing or borrowing side of our business, for your continued support. It really does mean a lot to us. I also want to extend a huge thank you to the very dedicated FMT team who never cease to amaze me with their passion for their customer service. We've had a really good year this year as a business. We continue to grow. We've now got offices in Tauranga, Auckland, Christchurch and now Wellington. Despite this growth though, we haven't lost sight of our core fundamentals, which are our investor first mentality. So all of our decision making, we always say, is this in the best interest of the investors, and also bringing that personal touch to what we do. We recently celebrated 25 years in business this year and we wouldn't have been able to achieve that without your support and also sticking to our core principles that I just mentioned, and also our prudent approach to managing our loans. And this is demonstrated across any number of measures, whether it be the spread of loans across the country, our low loan to value ratios, our very low loan arrears, and the quality of our borrowers. As we look to the future, we just intend to stick to what we know best, which is that personal approach, sourcing good quality loans so that we can provide the best possible return to our investors. As part of being an active and prudent manager, we like to stay abreast of what's happening in the market. So Tony Alexander gives us updates every week in the business, and each quarter he addresses the entire team and answers any questions that they may have. This quarter, Tony has very kindly allowed us to take questions from our investors and put this on our website. So thanks for joining us, Tony. Welcome to Tauranga. Great to have you here.
Yep.
There's obviously a lot of things happening in the market at the moment, both the New Zealand and global economy, with rising interest rates, inflation, things like that. So I thought perhaps if we could start with the inflation piece. How do you see that? Is it transitory or is it here to stay?
Yeah, well, this is the interesting question. New Zealand's inflation rate was predicted 6 months ago by the Reserve Bank to be just 2.5% at the moment. It's 4.9%, and we've got some groups expecting it might go as high as 6% in the near future. And clearly some of that is probably temporary, the surge in shipping charges internationally, etc. Raw materials prices are going up. So definitely there is a bit of a temporary element, but everything I'm reading from overseas suggests that the timing of this temporary period is going to rip all the way through 2022 into 2023. So we're not really going to get the falling shipping charges, etc., maybe until 2023. Now, the significance of that is that it means that people can see their cost of living has gone up a lot. They're going to naturally look for compensation with higher wages. So businesses are going to be having to pay higher wages and will naturally look to pass that on into their selling prices. And a key dynamic which since the global financial crisis has suppressed inflation has been that businesses couldn't put prices up all that much because as a customer I would go online, I would find a cheaper alternative produced out of Kazakhstan or something like that, and I'd get it shipped across to New Zealand. Now if a business puts their price up on me, I'm definitely going to go online and look for an alternative. Well, because of the supply chain and factory problems around the world, they're probably out of stock, or they can deliver it in 6 months, not 6 days or 6 weeks, and the shipping cost might be 4 times what it was previously. So businesses have some selling power now that they have not had for over a decade around the planet, and it says to me the risk is the inflation does keep staying at a relatively high pace here and overseas, and of course eventually that's going to bring an interest rate response.
Yep, which was my next question. So with the interest rate piece, where do you see interest rates going to and by when?
Yeah, the thing I've been saying for a number of years, thank goodness, is that when the Reserve Bank is raising interest rates, it's always a suck it and see exercise. You never know exactly how high interest rates will go, how rapidly they will get to the peak, how long they stay at the peak, when they fall, how quickly will be the fall on the other side. And that's because the reaction of ourselves as householders to rising mortgage interest rates, it changes over time. And so the Reserve Bank will raise interest rates, have a look and see what the impact is, and if it wants more impact, it'll raise them again. So it's always experimental. Now, what I've been saying up until 3 or 4 months ago was that if I were a borrower, I would probably lock in a 5-year fixed mortgage rate just below 3%, because when I looked at all the factors that were in play there, strong growth, tight labour market, etc. in New Zealand, it said to me, I think the inflation rate's definitely going to go up. The Reserve Bank is going to be raising interest rates, possibly more than people are thinking. Well, of course, now those 5-year fixed mortgage rates, I think they're pushing about 5% or so. And I guess my warning to people is that just over the past 2 to 3 months, we've got the inflation rate far higher than anyone expected, the unemployment rate far lower than anyone expected, a record net proportion of householders still expecting inflation will go higher, a record proportion of businesses saying they're going to increase their selling prices. So eventually, at some point, our central bank, Federal Bank in the United States, Reserve Bank of Australia, they're going to have to play interest rate catch up and maybe increase rates relatively rapidly. But that's a story, I think, for 2022. Yep. For the moment, they're still rightly focused on COVID concerns. But people should be prepared for interest rates rising over maybe the next 2 years, maybe another 2 to 2.5% above where they are today.
Yep. And so, I mean, something that'd be top of mind for our investors is, what does the rising interest rate environment do to the term deposit rates?
Yeah, well, they will go up. We've already seen some increases in term deposit rates are out there, and they will go up further. But we've got to remember there's a lot of money sloshing around our economy, sloshing around the world, and banks have really had no trouble sort of financing themselves pretty much ever since the lockdown came along last year. So I think the term deposit rates will increase less than the increase in the mortgage rates, the business lending rates on the other side. But they will definitely go higher.
Yep. And how do you see the global macroeconomic environment impacting on New Zealand? So the likes of the evergreens, for example, some of these things that are emerging.
Yeah, well, New Zealand, we are dependent upon what's happening in the rest of the world. Obviously, if export income makes up about 27% of the income, etc., for New Zealand, and especially what's happening with the commodity prices. And at the moment, we have the likes of the ANZ's monthly commodity price index running about 24% higher than a year ago. We've got high dairy prices. One measure there is almost 40% above where it was a year ago. We're looking at a record payout for dairy farmers in New Zealand. We're looking at strong red meat prices as well. The rain has fallen on the eastern coast of Australia. The grass is growing, so they're holding back the cattle so they can obviously get more of them, and that's pushed the beef prices in Australia to a record level. That feeds through to sheep meat prices. People are eating out more overseas, so that's good for the wine industry once they can grow enough grapes after a fairly poor harvest this year. And I look at the world economy as likely to deliver some good support for our export prices in the next couple of years. And of course, the reopening eventually of the borders will bring in the foreign tourists. So I think it'll be a relatively slow re-entry there, and the same for the foreign students coming in. So when I look at the overall world economy, it says to me, I think we're going to get good support for the New Zealand economy, but as interest rates slowly rise overseas and some of the stimulus related to COVID gets pulled back, world growth will slow down next year and the year after. But I think it's going to be supportive for New Zealand. And for things like China, with the excess construction of residential property over there, the excess borrowing by Evergrande and probably a good number of other property developers as well, it's definitely something to keep an eye on. It's highly relevant to Australia, say a pullback in house building in China, because it means reduced demand for the iron ore, various ingredients over there. What's more relevant to us is, will people continue to eat out and look to improve what they eat in China? And I think the answer there is, I think they will. So we won't be hit quite as much if Evergrande goes under as maybe Australia.
I suppose that the topic that's top of mind for our business is, how does this translate through to the property market going into next year and beyond, and particularly the housing market?
Yeah, well, let's just sort of start by noting that no sane person at any stage said, we're going to have a global pandemic, and as a result of that, house prices will only fall 3%, and then they're going to surge by 44%. We'd have locked them up. anyone saying that in March of last year. So we've all been massively surprised by the surge in house prices over this period of time. And that surge here and overseas, Sydney prices are up about 30% on a year or so ago. It reflects all the money sloshing around the global monetary system, the record low levels of interest rates out there as well. Things have surged, and so a part of me sort of says, well, even if prices were to fall 5 or 10%, you're only going back 3 to 4 months in New Zealand.
Yep.
And yet we've all sort of been brought up to fear falling house prices. Well, I guess the view I have is this. As a rule in New Zealand, house prices only fall when we're in recession and the recession has been preceded by very high interest rates. I do see the interest rates going higher. I don't yet think we're going to have a recession in, say, late 23 or 24. We'll see what happens out there. My view fairly strongly is there's still some pent-up demand out there, especially related to Auckland. As we head through summer, I think the market is still going to be relatively firm. There's some catch-up buying, but when you look at the interest rates are going up, mortgage rates are already up by 1.3 to 1.8%. The lending criteria from the banks in particular has tightened substantially over the past few months. The tax changes affecting the investors, the big supply of new houses coming forward, and I think we're going to suffer some net migration loss of young people across to Australia, higher wages. It says to me, the housing market is going to flatten out, I think, by about the middle of 2022. House price inflation, I think, is going to get close to zero in the second half of next year. But as to falling, I'm not prepared to call that as yet. We'll see what happens with inflation and interest rates.
Yeah, I mean, there's a lot of fundamentals, as you say, that are supporting a flattening but not a falling at the moment.
Yeah, that's right. But yeah, we just got to keep an eye on this because I've been in this business for over three and a half decades. I've seen many house price cycles, not just since our economy was deregulated in the middle 1980s, but even back to the 1970s. My father was a builder in Christchurch back at the time. He rode the building boom up, and then unfortunately we got weeded out in about 1977. And we can see house construction is very strong at the moment. Well, there'll be a pullback there at some stage. And the boom we've got in house supply, it's sort of a new element we haven't had around for half a century. And so none of us really has a model to figure out exactly what that's going to mean for prices in the next couple of years.
Yep. We talk about the supply chain disruption and the difficulty in getting materials. Do you think things like that will help temper the supply coming into the market?
Yeah, I think that we've got from a year ago, or just over a year ago, the year to March 2020, the number of consents issued for new dwellings to be built all around the country was 37,000. The average for the past 20 years is about 26,000 per annum, so that was already pretty strong. Now we've got 47,300 issued in the year to September. You look at the most recent months and annualise it, you're running at about 51,000, so 1% of the population. That takes us right back to sort of the middle of the 1970s. But yeah, with all the problems of sourcing staff, getting the materials through in a timely manner, not all of these houses are going to be built. And already, let's say in Australia, we've got some companies closing down and not completing developments. And I think in New Zealand, with the great rush in orders for property coming along, not matched by a rush of extra carpenters, electricians, and the potential loss of a lot of these tradespeople, I think, to Australia in the next couple of years, some of these developments are not going to go ahead, and some, unfortunately, will be left unfinished. I guess the good news here is that we've been here before, like heading into the GFC. We've all learnt lessons, the central bank, the government, the banking sector, lenders more generally. So I don't think we have anywhere near the same degree of risky, bad lending, financing developers heading into this than was the case previously. Thank goodness it's a very different world in that regard.
Yeah, and you... I mean, in your research, you talk a lot about, and you just mentioned then that building consents are at sort of 47,000, I think it is, and comparing that back to the 1970s, so it's sort of the highest level since the 70s, but obviously the New Zealand population is significantly bigger, so on a per capita basis, it's not quite as big as what we saw in the 70s, is it?
Yep, not quite as big. So the peak back then of the ratio of the number of consents to the population, that was 40,000 in 1975. The population just tipped over 3 million in about 1973. So what's that about? 1.3%? 40,000 sort of versus 3 million. Now if we're running underlying at about 51,000, that's 1%. So the 1% is the highest since back in about 75, 76, but it isn't as much of a relative supply boom as back at that time.
You've sort of already touched on it, but when the borders reopen and immigration is or migration is back on the table, how do you think that will flow through into the property market?
Yeah, so this is interesting. When we went into lockdown last year, and our eradication strategy was basically completely successful. Initially, there was a view of, we're so wonderful in New Zealand, the 1 million Kiwis overseas, they all want to come back to New Zealand, and as soon as there's space in MIQ or they don't have to go through the system, they're all flooding back. And maybe the other 7 billion people on the planet will want to come back as well. We sort of got a bit up ourselves in believing we were fantastic in New Zealand. Well, what's happened overseas is their economies have recovered very, very strongly. Their labour markets are strong. There's a massive shortage of employees overseas. Now, if you're a Kiwi overseas, 1 million of us, 600,000, 650,000 in Australia, you're probably there for income, for the job, the experience, all this sort of stuff, and you are massively in demand overseas. And my sort of thought would be, why would I come back to New Zealand for higher cost of living, high house prices, and maybe half the wage if I'm lucky, when I'm getting 15% increase offers right now for my job as an accountant in London or mowing grass across on the Gold Coast? And so my view is we're not going to see a massive flow of Kiwis back to New Zealand. I actually expect with 2 years worth of OE to be caught up on and the attractiveness of the strong labour market in Australia, we're going to see part of the current generation of young people up to 35, late 30s, move across to Australia. And it's what we Kiwis have done over the generations. At least once every generation, we have a big movement across there. Offsetting that is the government's move to allow 165,000 migrants, if they apply to become permanent residents by, I think it's August or so next year. That will add some extra buying into the housing pool. But what about migrants generally coming in when the borders open up? Finally, there will be some relief for the business sector there. But for over a year, the Minister of Immigration, Chris Fafoy, has stated quite explicitly when the borders open up, the majority Labour government will not be letting in as many working migrants visas as was the case previously. So that's a warning to businesses not to expect there's a big workforce going to flow to you. And it says to me, well, actually, I think population growth for New Zealand, I see below average for the next 2 to 3 years.
One of the things that we're seeing in our business and our lending, and particularly in Auckland, is a lot of people purchasing residential investment properties, but on sites that they see as being subdivisible in the future. And our analysis shows that they are paying some quite big premiums for this development potential. How do you think the cross-party accord that's coming into play supposedly in August next year, how do you think that could come into, how that could affect that part of the market?
Yeah, I'm just wondering if many people have got their economics wrong on this one, believing if I buy this section, I'm going to be able to put 3 dwellings on there, maybe sell them off, rent them out or whatever. That bit of land is valuable. But hang on, if you can do that on virtually every section in Auckland, what have we got, Auckland, Wellington, Christchurch, maybe Tauranga is in there as well. Hang on, we're talking about exactly what the government's aiming for, a big increase in the supply of land able to be built on. Well, when the supply of something goes up, the price generally goes down. So I wonder if some people haven't correctly enough thought through the implications of that change, along with the 1-year acceleration of the National Policy Statement on Urban Development, where councils cannot stop 6-storey buildings within walking distance of mass transit stations, commercial centres as well. There is a supply response coming through and a level of intensification that's coming through, and I do question the sustainability of some of the land prices that people are paying, some of the premium they're paying for some of the sections they've been snapping up, given that if I wanted to build something, I could buy virtually any section in a year's time and be able to put 3 properties on it. Yeah,
certainly something we're very mindful of, and as I said, we're seeing it in our analysis. We always use this term, the property market, in such generalised terms, and it always comes back to the housing market. But how do you see it reflecting through into the commercial market? So rising interest rates, what that might do to yields, which we've seen come down to some very, very low levels. What do you think might happen there?
For the moment, it seems like the yields are still coming down. I was just looking this morning at some analysis for Australia, and the graphs I was looking at were showing the yields were still coming down. And that reflects the weight of money in Australia, New Zealand, around the world, still looking for exposure to the commercial property sector. And in particular, according to a new survey I've started up of people's portfolio investment, in particular, warehousing and industrial property investors definitely want to sort of get some of those assets there. Well, you and I have been around long enough to know property markets move in cycles, and it's not just residential. And inevitably, when interest rates go up, there may be a lag, but it will feed through into the yields on the commercial property side as well for your industrial, the warehousing, retailing, office buildings, etc. I don't think that's necessarily imminent. And another survey I do of businesses, what are they seeing, what are their concerns? Basically, no one mentioned debt levels or interest rates. Nobody's really paying too much attention to what's happening in the interest rate. So in my opinion, we could actually get the yields fall a little bit further in the commercial property sector, but at some point next year, I expect to see them going back up again because of the upside potential for the interest rates.
Yeah, and even within that commercial sector, there are a number of subsectors, and for us, we've obviously post the COVID period, we see retail as probably being one of those, retail and hospo as being one of those riskier sectors, and we've certainly limited our lending to a large degree there. Do you see that as continuing as a potential risky sector?
Oh, yeah, I guess so. While we still have a view that everybody's going to shop online, that obviously the risk of lockdowns, etc., well, it's diminishing in New Zealand, thank goodness, but let's say just interruptions. I guess I often think in terms of Warren Buffett, he's always talked about, counter-cyclical investment. If everybody's moving away from a thing, then maybe he moves towards the thing instead. And as happens in every property cycle, there's a point reached where you look at it and you go, actually, I can buy this property, I can do some refitting, rejig it, so I emphasise more the experience of retail shopping as opposed to just the products there, and I expect there will eventually be a rejuvenation. Just as Centre of Tauranga is obviously going to have a rejuvenation when some of the anchor tenants come back in here and some of these currently empty shops get leased and everything's going to be vibrant again. So maybe we are near the low point in the cycle for the likes of retailing and hospitality, but I think it's still going to be pretty confusing for another 6 to 12 months as we work our way through traffic light system, reopening of the borders, etc.
Yeah, we talked about it earlier in terms of the increased regulation into the banking sector in particular, capital adequacy ratios, debt to income ratios, these sorts of things. How do you see that potentially flowing through to bank margins? Bank lending margins, I should say.
Yeah, well, the bank lending margins are compressed. In one of my weekly publications, every week I put in 4 graphs for mortgage lending rates, 1 year fixed, 2 year, 3 year and 5 year. And so I just do a basic comparison of the swap rate, let's say for 1 year, the cost to a bank of borrowing money to lend fixed for 1 year versus what's generally the best 1 year fixed rate out there. And so you get a graph going up and down of the margin for the bank. And I work out the average for the past 2 years. Well, for a long time now, the margins have been below average. And those margins for all of the fixed rate lending for the banks, they're still about 0.5% below average. So even if there was no change at all in monetary policy, wholesale interest rates, there's actually still about 0.5% of extra catch-up to do by the banks. And so earlier on, I think I mentioned the 5-year fixed mortgage rates were 2.99. Now you're pushing 5%. Well, there's at least another 0.5% increase to go there before we even sort of talk about where might monetary policy, etc., go. So comment I've made for 2 or 3 months is I think banks will use the fog of confusion surrounding monetary policy inflation to look to rebuild the margins. And when I'm looking across at Australia where there's just been a selling down of the CBA, Commercial Bank of Australia shares because their margins have got compressed and our banking sector is largely owned out of Australia, the bankers are going to be looking to rebuild margins in the near future. Extra upside pressure on lending rates.
Internationally, it's probably a good segue in, is internationally we see the non-bank sector playing a much bigger part in the lending market, whether it be Australia, US, Great Britain. In New Zealand, it seems to be in its infancy. Do you see the non-bank sector taking a bigger part of that market as the banks face into things like capital adequacy ratios and various other things?
Yeah, I think most definitely. It's been, I guess, an interesting period since the GFC, where we've had increasing regulation of the banking sector or the financial sector overall, which means we've gone into the global pandemic shock with New Zealand's financial sector, the institutions, in very, very good shape. I think it's one of the reasons why the impact on our economy hasn't really been all that bad. But now, as we see the debt-to-income ratios being applied there for the banks, the Credit Contracts and Consumer Finance Act. I had to memorise that a few weeks ago when I realised I didn't know what all the C's added up to. Running through the banks and affecting their assessment of applicants' expenses to a detail we've never seen before in New Zealand. People are getting loans turned down, young people, because the bank's saying you're spending $200 a month on coffee. Actually, I think that's conservative. And so that's running through, along with the LVRs, the reduction in low deposit lending. And I think we will naturally see the applicants move across to the non-bank lending sector. So I definitely expect to see growth, not just a sort of cyclical thing. I think it is going to be a bit of a structural lift over the next 5 years in the size of the non-bank lending sector in New Zealand.
Yeah, and that sector looks a lot different to what it did pre-GFC, doesn't it? I mean, our whole financial landscape looks different in terms of we don't have the proliferation of the finance companies and the like, so probably provides a much more robust platform for lending going forward.
Yeah, the world is completely different from what it was pre-GFC, I suppose, for the finance companies. The banking sector in New Zealand and their assessment of risk, a lot of that was addressed in the early 1990s after the share market boom from 84 to 87, the share clubs and the banks trying to outbid each other to lend as much money as humanly possible. A lot of changes were made there in the late 80s and the 90s, but it's like the finance companies, the central bank didn't pay any attention. Well, now, of course, the attention has been paid ever since, well, before the GFC, actually, quite frankly, just a bit late in the piece there. And it's actually been surprising over the past few years that we haven't maybe seen more non-bank lenders grow in New Zealand. I think the growth will come from a shift in the existing business rather than necessarily new players that we've never heard of before entering the New Zealand market and grabbing a lot and producing more activity. But it is a different world in the financial sector now from pre-GFC, and obviously everything's different from 84 to 87.
Yeah, that's right. Yep. Now look, we could actually talk all day here, Tony, because there's a lot to talk about and it's pretty interesting. But I suppose as a wrap up, is we if you're summarising 2022, what might that look like? 2022
will involve, I think, the housing market flattening out, talk about brain drain to Australia. There'll be talk about wage price spiral with wages going up. I mean, with inflation. Inflation is a measure of the change in your cost of living. So the inflation rate is 4.9%. The average household's cost of living has gone up by 4.9%. And if you haven't had a 4.9% wage increase, you are poorer now over this past year. So there'll be increased wages, increased inflation, and of course we're all going to be learning stuff about reopening of the world economy. I have a positive outlook for our economy, but I'll be giving a warning to the business sector generally for some time. You've got to be careful of the growth that you're planning. Just because I say it's a good outlook for the economy, I'm talking about demand from customers generally is going to be strong, but that's not really a problem for most businesses these days. They've got more customers than they can service. Their problem is finding the staff, finding the materials, maybe the premises, the computer experts to redesign the computer system. And my comment to businesses has been, for the environment going forward, focus a bit less on marketing, branding, advertising, more customers, and a lot more on keeping your existing staff. What does it take to keep them? Fish and chips on a Friday, is it? Frankly, for some, it's going to be all. Your supply chains, focus a lot more there on what resources can I command for the next 5 years, and then see what level of output will that actually allow you to sustain going forward. They've just got to reverse sort of things. And if you find somebody who's very good with HR management, human resources, supply chains, pay a premium to get that person on board, because they are becoming more valuable than the marketing executive in this new environment.
Yeah, no, very good. Thank you very much, Tony. We really appreciate it. I'm sure everyone watching this has taken a lot out of it. So thanks again.
Okay, thanks very much for having us. And I certainly hope so. Cheers.
Cheers.